Hello everyone and welcome to Momentum Finance channel. My name is Mo, and in this video I'm super honored to be welcoming back one of our favorite guests, Perry. Yeah, welcome to the show, Perry.
Hello. Good. That's honored to be here again.
It's my pleasure. Perry is a retired Canadian investor who has been receiving very much consistent cash flow and passive income through their sizable portfolio. Their distributions is almost in the size of and in tune of $40,000 per month, give or take. And in this video, which is a follow-up to the past invite that we had for him on the show, we're going to be taking a little bit more closer look under the hood. He'll continue to share and update us on where things are at since we last chatted with him. We are going to take a look at some of his current holdings, how they've done in terms of ups and downs. We'll talk about as well some of his key learnings along the way and much more. I assure you don't want to miss this interview, so let's get into it without any further ado. Perry, I know we are all itching to find out since we last chatted, how has your portfolio done? What is the current size of your portfolio in terms of your overall holdings across all of your accounts?
Oh, glad to be here. And again, honored that you would invite me to it again. I think I talked too much last time. That's why you needed a second interview.
No worries. No, I know we ran out of a bunch of questions last time, and we wanted to definitely touch on those important ones this time. So I'll come back again.
No problem. So generally, nothing spectacular. I know that the markets have been going up since the big April dive bounce up in the global markets. So, but for me, it hasn't really. It's basically been going up steadily. You know, in my environment. I wouldn't say that, you know, I've heard some people say, oh yeah, no, I've seen my portfolio hit all-time highs. I'm generally in the same place. I have definitely improved from where I was when Trump came into office in that last the 2 months after that, when all the markets really went for quite a bit of a dive. I'm showing you my Snowball Analytics website, which is the central dashboard right now. The number you see right now is my current portfolio. This is all my accounts. So my portfolio is, I think I mentioned the last time I interviewed, my portfolio is made up of 4 RIFs. My wife's SRIF, spousal RIF, and 3 of my RIFs. So there's 4 combined. And then there's 2 TFSAs that are also that make up my portfolio. And finally, there's a non-registered account that basically holds only my growth shares. I have no covered call ETFs in my non-registered. So when you're looking at this results right here, you're looking at all 7 of the accounts combined, including my 3 growth stocks and all my currently, as of today, now 27 covered call ETFs, because I just added a new one. My current balance was 1.586 million. In about April or March, April, when things were looking really bad and markets were going down with all the tariff attacks and stuff, I was down to almost 1.28. So I've actually recovered quite a lot from where I was. So I'm happy to see that. I'm almost back up to 1.6. The Snowball Analytics shows my total invested, so it'll also show how much I've invested in it. You can see that I'm at total invested for me, which would be my book cost, is really what that is 1.768. So about 200,000 below that. I don't worry about that too much because it's all unrealized loss. And that's all recovered by me doing reinvestments. So my objective, again, Mo, and I think I've said this last time, I am very strongly a passive income investor, which generally part of that strategy is called buy and hold. I don't worry generally too much about losses, and we'll talk about that later when I show you my spreadsheet. Because really my objective is not to increase my NAV. My objective is to maintain and keep increasing my monthly distributions and maintaining my yield, or even trying to increase my yield. So that's why this number, it's, would I like it to see it at 1.7? Sure, but it doesn't bother me at all. My big number over here, Mo, is the second cell right here. Mm-hmm. This is how much my profit is, as well as which is currently my profits are currently at 566,000. My IRR, my rate of return is currently at 22%, which is basically my capital, my non-realized capital losses plus my my passive income. So when you put the two together, you can see it's 22%. That's why you see that my current holdings is -10, because it's the drop down from the my non-realized capital versus my income that's at my yield that's currently at 31.88%. So my IRR is at 22%. Just some quick analytics, and again, that's why I like my snowball analytics. My dividends are, again, my key aspect of what I'm doing. So again, I focus on how is my, when I look at how my portfolio is performing, I'm looking at how is it performing with regards to doing distributions in yield, and then and how healthy are they doing it. So if you look over here, you could see my yield payout. And these are interesting metrics because, for example, USOI, which is actually one of my biggest, if you look at capital losses, it's actually down 50% from what I paid for it. And you can see that because that little green bar that you see there is showing my yield on cost. So you can see my yield on cost is only 62%, but my yield is 103%. So right now, USOI is my biggest payer when it comes to yield payout. And I'm talking about percentages, not actual
is that one of the recent editions, Perry, or
of this?
Yeah.
Oh, USOI? No, I've had USOI for about, I would say 8 or 9 months, if I can remember correctly. Hang on, I actually know. Yeah, I've had USOI for quite a while already. So I can tell you right away. Hang on. USOI 12 months. I've had it for a year actually.
Wow. Yeah.
So, and the reason I like it because one of the sectors I have always seemed to like is the Canadian and U.S. Oil sectors. USOI is the American version of it, so it follows the American oil commodity. And ENCL, which is the other one that I have, is the one that follows the Canadian oil sector, oil and gas sector. So that's what that is. But other than that, the new one I just bought here is Alti. You can see that right here. I finally said, okay, I liked seeing what it was doing. And I finally, as of today, just increased my holdings from 0 to 1.3%. So this is my new baby right here is Alti.
Does it pay its distributions on a monthly basis, this one?
No, so that's couple of the reasons I liked it. One of them is they switched over from monthly to weekly in March. I wasn't really a fan initially of weekly payouts, but I've slowly gotten used to liking them. I'm now with Alti, I now have 6 covered call ETFs that pay weekly. So I don't have a desire that they all become weekly, but it is nice that every Friday these 6 will pay out a weekly amount. So that's one of the things I like about it. The one thing I really liked more about it, which I didn't like about it at first, is it was showing sort of signs of erosion in the sense that they seemed like YieldMax was trying to put out more yield on it than it actually can earn. And you could see it in the stock price. It was the stock price and the NAV, it was dropping. But I just saw 2 interviews, one just from Coach with Jay Pestercelli, who is sort of like the god of YieldMax contracts. They're the one, he sort of heads up the team that writes all the contracts for Defiance and YieldMax. And he actually mentioned that Alti, they've done some changes to protect the NAV a lot more. And I do actually see that if you look at their chart, you could see that they've really, the NAV is really flattened out, and it's actually sort of even going up. Now, some of that's going up because the market's going up, but so we'll see if we have another nosedive, how Alti does. But I think we would have seen that anyways because the ups and downs were there before, and you could see Alti was declining. But over the last 4 months, Alti has actually been very flat, which in my opinion means that their protection measures that they've put into their strategy, it seems to be working. So that's why it sort of convinced me. I love the high yield. I like that it's weekly, and I like that they seem to have stabilized and figured out how to stop their erosion on that one. So
very interesting.
Okay. Down a little further here, ignore some of these boxes. So don't look at this one because beyond me, I don't know why Snowball Analytics does this box. I wish they could pull it off because it makes no sense. But this one over here shows my projected 12-month income forecasts. And you can see right now, I'm sort of running at a monthly 41K projected for the year. I'm the last few months, it's been under 40. It's running around 37 to 39. But you can see the numbers are go up and down. So over here, you could see that for August, it's supposed to go up to 50. The reason that's happening, Mo, is because a lot of these now don't pay on a monthly basis. A lot of them are now paying on a weekly basis or every 4 weeks. But once or twice a year, we have 5-week cycles.
Right.
So August is one of those months that there's actually 5 weeks in it. So that's why you see it at 50,000, because an added week will be put in there. And that's why I'm going to get 50,000 on that one, because that extra week's going to show up. Okay. But generally you could see I'm keeping it flat. I really honestly don't, unless something amazing shows up, Mo. I'm very happy to try to maintain a 35 to 45K a month distribution. They'll have bad, when we were really bad there in February, March with all the tariffs, I saw my portfolio, my distribution drop to about 34,000. So that is one of the reasons why some people ask me, is like, oh, why, if you only need 10 or 12,000 to run off, why are you running so aggressively and trying to maintain a yield of 30 or 40,000? Well, here's the reason why. Because when we have horrible bad market days or global market conditions, I don't have to worry about, oh my God, I'm running at 15K, but I need 10 to live, and so my buffer is really small. Well, if I have a buffer where I can easily comfortably run at live and I mean comfortably live at 10K per month, if I'm at 40 and I drop to 30, I don't lose any sleep overnight on it, Mo. So that's the reason why I like maintaining a higher yield, because that way, if we have a whole year of 30,000, yeah, sure. I really wish I was at 40,
right.
but
Yeah.
I can easily get to sleep at night when it was running at 30.
Yeah, right.
Yeah.
I totally get it.
Right. And then this one here is over the entire period. So this shows me all my ETFs, and you can see some of them are really small. Well, that's because they're newer ones or they haven't just started paying. So this is over the entire time I've held an ETF. Coney is still my big behemoth. It's paid me over 80,000 over the entire lifetime that I've had it. And I'll show you on the spreadsheet, because this is very important. People are like, oh yeah, but look at Coney, they're down like 60% or whatever. It's like, yeah, they're down 60% unrealized, but it's already paid me more than I've actually paid for it. So that's why I don't look at what the losses are that much. I look more for what my distribution, if I can maintain distribution. So yeah, Coney's not paying what it was. It used to be paying 5-6K. Now it's only paying 2 to 3K, but it's still paying, and I'm not putting any more money into it, but it still pays me 2 or 3K a month. So, so it is still the leader, because during its glory days, it was paying a lot, right? And this just here shows me quickly, the yellow is the 2023, the blue is 2024, and 2025 is purple. All I show here is I'm going to try to maintain, a general area between the 30 to 50 range. As long as I could keep my distributions in the 30 to 50K range, I'm okay. I'm happy.
Very, very interesting. Does it show you, Perry, as well, like what's the yield on cost for each one of those holdings? So let's say Coney,
Yes.
you might have bought it a long time ago. So right now, the yield.
Yeah, I'll show you that one. This one here, Coney. Where was that one? I saw them over here. So here's Coney right here. There's the difference right there. So you see right now, if you were to buy Coney right now, it's offering you a 64% yield. But my yield on cost is only 31%. So based on how much I paid for it, which, it's gone down. I think I'm down like 40, 50% on it. So that's why my yield on cost is currently only 31%.
Is that currently in your existing portfolio, Coney, in terms of the price return, the worst performing one? Is that the one?
Oh, no, I think again, hard things. What do you mean by performing, right? If you're talking about my biggest loss
just on paper, not based on total return, because obviously, to your point, you got a lot of distributions that if you count them in total return, you might already be in the positive fund.
Let me show you that.
Yeah.
This is nice. This is what I like about Snowball Analytics. So here it shows me every one of my ETFs and what their 5-year range. So 5 years is beyond my because I've only been doing this for 2.5 years. So this one shows you who my biggest loss leaders are right now. PEI and HMR, those are my high risk small cap stocks. They're the ones I'm hoping someday will go up. So yeah, don't even look at those. Those are like, they're my play. They're my play money. So, my biggest loser right now is HPYT, which is, it's basically a long-term dividend or bonds. It basically would do better if our inflation were to drop and stuff like that. So it's my biggest loser right now, and USOI is my other biggest loser. When you would put together its capital loss versus its gains on distributions paid. So you can see HPYT is actually my biggest loser. Mm-hmm. Now, my biggest winner right now, and this is sort of, I may then not even answer this question. When people say all ETFs, all covered call ETFs erode, oh yeah, they're all going to go down. Well, a little hard to say that when you can see my CNYE from Harvest, I'm up 70%. And that's capital gains or non-realized capital gains and distributions, but most of that is capital gains. So if I were to sell it, most of that 70% is capital gains, because it hasn't paid out that much lately. So, because it's only like 3 or 4 months old, or 4 months old. So when people turn around and say, well, look at this, and call was another one which I did so good on. I actually did something that I generally don't do, because I think one of your questions is I'm going to answer the reverse of that one, Mo. Some people say, well, if the markets are really bare for so long, would you ever consider selling it? No, absolutely not. That's when I'm looking at buying things. So no, I would never sell any of my ETFs if it's in a long-term bear market. My bigger problem, Mo, is the fact is, what happens if I have an ETF that's doing so good in capital gains that should I sell it and realize the capital gains? Call was one of those that I decided to do that with. But I didn't sell all of it. I sold. I had so much gains on it, Mo, that I decided that I was going to trim off the extra gains and bring it back down to the yield that it was. So call was one of those that I actually sold some of it off. And the only reason I did that with call is because call's yield is generally low to start with. It's only in the 14%, 15% range. So I wasn't really worried, because I knew that the money that I cashed out from the realized capital gains on call, I could put into something like HHIS and actually generate higher yield on. Right?
You could have redeployed it. And I know last time we chatted, Perry, you were talking about your written rules. So one of them around the size of each holding in your portfolio. So I think that was one of the triggers as well. Like you wanted.
It was, yeah, and that's the problem, Mo. Exactly, yeah, you nailed it. So one of my rules is that I basically set a target weight for every one of my ETFs when I buy them. Well, call was gaining so much that it was beyond its target weight. It was already, let's say it was 4%. Well, it was already at 5.5 or 6%. I would generally leave it alone if it's also a high yielding one that's doing really good. But since call was one that was actually, it's only at 14% yield, I'm like, man, I could trim off the capital gains on that one, and of course tax free, because it's in my RSPs and in my TFSAs, and take those capital gains and redirect it towards a CYNE or CNYE or an HHIS, where I can actually now make more money on yield from the capital gains on call at a lower yield.
Makes sense. Yeah, I totally see. And it's good to have some of those rules written down. I know last time we talked about it in depth, because particularly when, market goes maybe very well or sometimes totally the opposite, those are the times that, if you have those rules and decision points written down, you're more likely to follow through that.
Absolutely. And I think that's the key thing for people that actually do well with their portfolios versus those that say, like, every time I invest, I'm losing money. It's the people that don't understand their investment philosophy or rules, and even if they do understand it, they break their own rules because they panic. Either, some people, I think the good word turns, if it's FOMO, like something's going up and it's like, oh man, I should have bought that PLTY or PLTE because it's so good, I'm going to buy in, and it's at $23. And then of course, sooner or later, it's going to go back down to 13 or 15. And it's like, oh man, I've lost money. I'm getting out of this dog. So they're literally doing the opposite of what their rules are. So discipline on your rules. One, knowing what your rules are, and two, sticking to your rules are the two things that differentiates a successful investor from a failing investor. The other thing is, of course, there's a lot of growth Blossom members that really focus on growth. So I'll show you that as well. So this is the performance of my portfolio. So my portfolio value. The dotted purple line is showing my withdrawals and investments. So it's basically saying if I'm selling something, that's where it's going down. If I'm reinvesting money, I'm going up. What this doesn't show you, and I don't want to do it with my Snowball Analytics because literally I'd have to start from scratch. It doesn't show cash in, cash out movements from outside of my portfolio. Something I'd like to show, because the one thing this doesn't show me is every month I take $10,000 out to live on. And it doesn't show me taking $10,000 out. Okay. So, but what it does show me that inside my portfolio, whenever I'm making a sale, such for example, this over here was me selling Athabasca. I sold I sold it when it was at its $6.15 high, and you can see it came down. So then after I saw that Athabasca was actually down big time, I actually bought some back. So I was doing swing trading here. You can see that happening. But a lot of these little bumps that you see keep going up. Most of them are going up, going up, going up. Those are me reinvesting. So for example, when every month I make about 40,000. Every month I only need about 10,000. So I have a lot of excess cash that sits in my cash balances of my RIFs and my TFSAs. So I decide, like I did today, and I said, okay, I'm going to use, so you can see that happening here. It went from 1.72, it went up to 1.31. So basically, I think it was about 16K I put towards ULTY. So you can see that was my investment that was my reinvestment of my cash there. But the other one is this is comparing my portfolio to the S&P. And you can see right now, if it looks at a 1 year perspective, I'm actually beating the S&P when you compare my distributions as well as the profit loss. So I'm likely down compared to the S&P with regards to my capital gains, capital losses, but I'm more than making up for it in my distributions. So that's why, here's a good example here. Like you can see, this guy gets in the way all the time, this damn thing. So you can see it, this likely was, I don't know why actually I know why. This is because I went down when I sold, so that doesn't count. So it shows both the S&P. But generally speaking, I'm likely beating the S&P right now because I'm making more in distributions than the S&P is making in capital gains.
Interesting.
Now, that being said, over a 5-year period, which basically is my entire 2.5 years, the S&P is slightly beating me. And again, I don't know exactly why it goes. Something happened earlier than 1 year ago, but it's actually beating me by a little bit over a 5-year period.
Could it be fair that, Perry, probably over the past 1 year, S&P didn't do as well, and then in your case, you're also a lot of your investment covered calls are more targeted, right? So they're targeted sort of like a subset of probably what you find in S&P. S&P as a whole didn't do well, so that. In other words, I know earlier before we hit the record, you were talking about you're more an active investor.
Yeah, I know we talked about do you believe in buying ETFs that are active versus passive? I mean, most of the covered call ETFs that are higher yielding are already actively managed. And that's why some people, there's a lot of people on the growth side and the stuff. Oh my God, look at you're paying 1% MER, 1.2% MER. First of all, some of it is because it's leveraged, and the leverage cost is in the MER. That's the one thing. But even if it isn't, the reason that these are having higher yields is because the fund managers or the ETF managers, they are actively writing contracts every day, having to think which way they do, how close are they going to do it to the strike price. So in order to have the kind of yields that these covered call ETFs like YieldMax and HHIS and that are offering as yields, their managers are sitting there daily doing a lot of work. Whereas if you go something that's like, I just follow the index, so my MER is 0.02, well, because it's all done programmatically. There's nobody sitting there every day writing contracts. So I naturally believe in an active managed portfolio or ETF because that's what covered call ETFs are all about. Okay.
Thanks for sharing.
And this one here is sort of my portfolio performance. And you can sort of see it here as well if I put the comparison with the S&P. So they, again, I'm not looking for like, oh my God, look at over here. Look at how it's bad here. Generally speaking, Mo, what I want to see here is that the two are tracking together. Like, I don't want to see my blue line going down while the S&P is going up. Right?
Huge divergence, yeah.
That I don't want to see. But generally speaking, I don't worry about if the S&P is beating me here or I'm beating the S&P. It really doesn't matter to me. My focus is income. So as long as my portfolio is generally tracking the S&P, and it's, as you can see here, it's tracking it pretty well. Like it's actually doing a pretty good tracking it. You know, over here, if I do it over 5 years, you can see there's a bit of a gap.
Bigger gap, yeah.
But again, I'm not sitting there saying, oh my, I can't keep up with the S&P's growth. I'm not looking for growth, Mo. I'm looking for income. So the S&P doesn't provide me any income other than some small dividends. My portfolio provides me more than enough in income. So I'm not really losing sleep at night that my portfolio is behind the S&P.
I know, Perry, sometimes folks ask like, oh, well, couldn't you maybe, let's say, invest in S&P and then sell when you need money? But I think one counter thought process that I've heard, and I'm not saying I'm going to validate that with you, for folks, is that, you're comfortable enough with this strategy and setup. You're comfortable that it may not over long periods of time beat S&P, but that way you don't have to even have the hassle of like the comfort trouble, right? The comfort on a certain levels, like weekly, monthly, whatever that might be, bi-monthly, you're getting automatically that payment that you don't have to worry about, oh, now I have to go and initiate a transaction to sell it or buy it.
Well, exactly. And yeah, so there's two arguments. There's two reasons why I don't worry about that as a counter to this. Why don't I do the S&P and then sell when they're higher and buy when they're... First of all, that's market timing. And how many financial planners are going to say you should never time the market? So doing that is literally breaking one of the primary rules is you should never time the market. Well, if I had a growth portfolio, and again, nothing against growth, if you're going to buy and leave it there and let it grow for 5, 6, 10, 15 years, that's fine. But anybody that's using a growth portfolio to try to maintain an income where I say, okay, it's June, I need $10,000, let me sell a little bit of my Intel or some of my Microsoft, I don't have to worry about that. I make it.
It's taken care of for you.
It's taken care of for me because if my focus is income, why do I care about the growth? And that leads me to my second point, which is some people say, yeah, but the S&P is going to beat your portfolio hands down every time. I could have gained another 15% ROI or return on that. Okay, so here's my analogy to that one, Mo. If there's $400 on the table and I only need $100, and I know that my portfolio could take 200 off the table every month, not 300 or 400, but it could take 200 or 300 off. Do I really care that I left 150 or 200, $150 on the table? No, I only needed 100. I'm getting over 250 off the table. And if I'm leaving 50 or $100 extra on the table, I'm already getting more than I need. So that's my other argument is, okay, maybe the S&P would give me a total return in 30 years better than my portfolio. I don't need it. I need what I need.
About optimizing either, right? So your priority and values are different, right?
Yeah, you're right. My priorities are in generating a consistent portfolio income. So I don't sit there when the growth purists turn around and say that, but I could do way better with the S&P and grow, and I could have taken your money and made another $58,000 on it, which this chart can show you on growth. I'm like, but I didn't need it. What you can't give me is $40,000 every month that I know that right down to the day. I tell my RIFs to take out $10,000 every month on the 15th of the month. I don't have to worry about if there's cash there. I know it's there. So they call it passive income for a good reason. I don't worry about if there's money on the 15th of the month when my RIFs pay out all my money so I can go on vacation.